Retirement investing can be super overwhelming for beginners. And one of the most commonly asked questions I get is, what is the difference between the Roth IRA and the 401k, and which one is better for retirement investing? And it makes sense that I get asked that question a lot because these are probably the two most popular types of retirement accounts. The chances are when you're young, someone has recommended for you to open up a Roth IRA, even if you have no idea what that means. I know when I first entered the workforce and started my retirement investing journey, there were so many different terms and accounts and investment types that were thrown around, and it was honestly super overwhelming. And I like numbers, I like personal finance, so I did a ton of research to figure it out and come up with the optimal retirement investing plan for me. But I could also understand why this is such a tricky topic for so many people because there's so much information out there and it's very easy to get overwhelmed. So honestly, the hardest thing to do when it comes to investing is just knowing where to start and then actually getting started. And I know a lot of you can probably relate to my same scenario, as you're probably hitting the stage of life where you're thinking about opening up IRAs or 401ks and you're just thinking about your retirement in general. And it's likely that you're still probably trying to figure out what a Roth IRA even is and how that differs from the 401k that's offered at your workplace. And you're probably also trying to figure out the difference between a Roth investment account and a traditional investment account. Or you didn't even know there was a difference. And in that case, it's a good thing you're watching this video. Now, if you've already started your investing and personal finance journey, you probably already have some understanding of what these different terms actually mean. But let's start off this video by quickly breaking those terms down before we jump into the analysis on which type of account is actually better. And let's start by hitting that subscribe button. It really helps out the channel. I'd really appreciate it, so thanks. But no, for real, we're going to be talking a lot about investments and taxes. But please know that I am not a certified financial planner or advisor, and I'm not a tax professional or a CPA. I'm just sharing my personal experience and my personal research when it comes to these topics. But before investing your money in anything, make sure to do your own research, and if needed, make sure you talk to a certified financial advisor. And with all that out of the way, let's get back to the good stuff. Now, the biggest benefit with opening an IRA or a 401k is the tax incentive that you get with your investing. And these tax incentives fall into two categories: the traditional tax incentive and the Roth tax incentive. So let's differentiate between those two types of accounts. And let's start with Roth. Now, a Roth investment account allows someone to put in post-tax money into that account, which essentially means money that you've already paid your taxes on. However, once that money is in your account, it will then grow completely tax-free, and at retirement age, which is 59 and a half, it can be withdrawn completely tax-free, which means that while you do take the tax hit up front because you're paying taxes on that money when you put it in, you save a ton of money over the long run because your investments, again, grow tax-free and can be taken out tax-free, which is going to lead to a lot of money made from compound interest that you don't have to pay any taxes on. So for example, let's say that at age 60, you have a Roth investment account with $500,000 in it. That means that that entire $500,000 is yours to be withdrawn, and once you withdraw it, you pay no taxes. Now, you can either withdraw or you can leave some of it in there to keep growing tax-free, which of course is what I would recommend, but anything you do take out, tax-free. Okay, so that's the Roth. Now let's talk about the traditional tax incentive. Traditional investment accounts almost work the opposite way. All money put into a traditional investment account are tax deferred, meaning you actually do not pay money on the taxes you put into a traditional investment account up front. So for example, let's say that you made $80,000 in a given year and you contributed $20,000 to a traditional IRA or a traditional 401k. Well, that $20,000 would be deducted from your taxable income, meaning you would only pay taxes on $60,000 of your income. But obviously, the feds want their money eventually. So at age 59 and a half, you can withdraw from this account, but anything you withdraw is going to be taxed as regular income. So moving to another example, let's say again, you're at age 60 and you have a traditional investment account with $500,000 in it. You decide to withdraw $100,000 from that. You will now have to pay income tax on that $100,000. Now you still benefit because you have more money invested at this point because you haven't paid taxes on it up until you start withdrawing, allowing it to grow faster than normal. But eventually you will have to pay tax taxes on that money because the government wants their share. So this benefit is still great as it allows you to grow your investments faster. And it's also tax relief at the time you're putting the money in as it's reducing your taxable income. But I also almost view this as the government's way of investing in you. While they take a hit on the taxes up front, they eventually do get to collect taxes on a greater amount because that money has been invested. So I view this as a win-win, but I just wanted to point out the benefit for the US government as well. Okay, so we've established the difference between a Roth tax incentive and a traditional tax incentive. So now let's move over to investment accounts. And for this video, we're gonna focus on IRAs and 401ks. Put simply, both are types of accounts that were made for retirement investing. IRAs can be opened by anyone as long as they meet certain criteria that we will expand on later. However, 401ks are accounts that are sponsored or provided through your employer. So to open a 401k, you have to have this offered to you through your place of employment. And if you're self-employed, there are products called solo 401ks, so there's always one-off options, but for most people, it's just going to be offered through their work. So even though 401ks and IRAs are both used for retirement investing, they do have some different rules and restrictions surrounding who can actually contribute to them. And they also have different contribution restrictions. But once the money is actually in there, then they do act very much the same as far as tax incentives go. But an important thing to know is that you should hit that subscribe button. I'd really appreciate it. Thanks so much. Let's keep going. Now, something that's important to know is that both accounts, either an IRA or a 401k, can have either the Roth or the traditional tax incentive. So Roth and IRA are often commonly attached to each other. People love Roth IRAs, but it's important to know that you can actually have a Roth 401k as well. So just remember, Roth and traditional are terms used to describe the tax incentive, but they're not tied to a particular type of account. There's multiple accounts that can be Roth and multiple accounts that can be traditional. So now that we've covered that generally, let's now jump into the specifics on the 4 types of retirement accounts we're gonna focus on in this video. And we're going to cover the Roth and traditional IRA and the Roth and traditional 401k. And I'll help you decide between Roth and traditional what is the best for you. All right, let's start with the IRA, which actually stands for Individual Retirement Arrangement. A lot of people think the A stands for account, which isn't fully true. More specifically, let's start with the Roth IRA. Like we just talked about, this type of IRA has the Roth tax benefit where you pay money on the taxes you put in up front, but once the money's in there, it grows and can be withdrawn at retirement age completely tax-free. Now, the government has recognized that this is an extremely powerful investing tool, so they have added some limitations to it because ultimately they take a tax loss on these accounts. The first restriction is that you must make below a certain amount to contribute to a Roth IRA in 2024. And this year, your modified adjusted gross income must be below $146,000 for individuals or $230,000 for married couples filing jointly. The second restriction is that you can only contribute a certain amount to a Roth IRA every year if you qualify. And those contributions are capped at $7,000 a year for 2024. But note that if you are 50 years old or older, you can actually contribute $8,000 for catch-up contributions. And the third rule is that contributions must be earned income. So basically, if you make no taxable income, you cannot just have your parents give you $7,000 to put in a Roth IRA. It has to be money that you've earned yourself and pay taxes on. And the IRS will catch you on this if you contribute money to your Roth IRA, but you didn't actually report your taxes for a given year. So their system will see that you earn nothing, but you contributed to a Roth IRA and it will flag you. So if you decide to put $7,000 in your Roth IRA, make sure that your qualifying income is at least $7,000 for that year. And make sure you report it to the IRS in tax season. Okay, moving on from the Roth, let's go to the traditional IRA. And it's probably obvious, but traditional IRAs have the traditional tax benefit, meaning you pay no money on contributions up front, but when you go to withdraw that money at retirement age, you pay regular income tax on those withdrawals. These accounts also have some restrictions and limitations associated with them, but they do differ a little bit from the Roth IRA. Here's how. Number one, there is no income restriction with a traditional IRA. So anyone, regardless of income, can contribute to this type of account, as long as they adhere to this next point, which again is that it must be earned income. So make sure you're only contributing money that you earn yourself and you're declaring on your taxes. Now, the Roth IRA and the traditional IRA both have a contribution limit of $7,000 per year. However, it is important to call out that this $7,000 limit applies to all IRAs together. So you cannot put $7,000 in a Roth IRA and put $7,000 in a traditional IRA. $7,000 in any IRAs total. or again, $8,000 if you're 50 years or older. And keep in mind that these restrictions and regulations are changing on a year-to-year basis. So make sure that you're consistently checking the requirements and that you're staying up to date on the IRS's policy so that you don't get in trouble and so that you can also maximize these as much as possible. All right, so that's enough of the IRA. Now let's talk about 401ks. Like I stated earlier in the video, 401ks are employer-sponsored retirement accounts that offer the same Roth and traditional tax incentives that we talked about with the IRAs. But let's jump into a few specifics. One big perk that is often associated with the 401k is the employer match. Now, not every employer offers matching with their 401k program, but more and more companies are electing to offer this to their employees. Essentially, an employer match is when a company will match all or a portion of your own 401k contributions to your 401k up to a certain percentage. For example, let's say your salary is $100,000 a year and you decide to invest 15% of your income towards your retirement using your 401k plan, and your employer matches 100% of your contributions up to 5% of your income. So let's break down these numbers. That means that you would personally contribute $15,000 of your income towards your retirement or your 401k, which again is 15% of your salary. And your employer is going to contribute $5,000 towards your 401k because again, they're matching every dollar you put in up to 5% of your salary. 5% of your salary is $5,000. And because you contributed at least $5,000 to your account, they match that. Now, 401ks generally fall into two categories, just like the IRA. Again, there's always one-off products, but for most people, these are the two. And again, it's Roth and traditional. Now, the first and most common is the traditional 401k. Roth 401ks are definitely a little bit more rare, but I'm starting to see employers offer them more and more frequently. So let's start with the traditional 401k. The traditional 401k offers the same tax advantage as the traditional IRA. So it's tax deferred contributions, but you pay taxes later. And there's also some limits and restrictions with 401ks. For 2024, the most money you can put into a 401k yourself is $23,000 for individuals. If you're above the age of 50, it's $30,500. Now that limit is $46,000 if you're a married couple filing jointly, or $61,000 if you're 50 years or older. And these contributions do not include any employer match. It's only limiting how much you can personally put in. So don't feel like you need to add what your employer is giving you to those totals. You can personally put in up to those limits. And the best thing, there's no income limits on a 401k. Anyone can contribute regardless of income. Okay, let's move on to the Roth 401k, which like I said, is something that a lot of workers are not even aware of. I even had a difficult time finding out about this when I set up my 401k for my work. It's something I really had to dig for to find out I even had access to it. But keep in mind, just because your employer offers a traditional 401k does not mean that they also offer a Roth 401k. Roth 401ks are definitely less common, but again, they are becoming more frequent. Roth 401ks offer the same tax incentive as the Roth IRA, where you pay tax on the money you put in up front, but then it grows and can be withdrawn tax-free. Roth IRAs have the same contribution limits as the traditional IRA, and similar to a traditional 401k, Roth 401ks have no income restrictions. So anyone, regardless of income, can contribute to a Roth 401k. Roth 401ks are an extremely popular investing tool because they offer the same tax incentive as the Roth IRA, but ultimately they are much better because the contribution limit is much higher and there's no income restrictions with the Roth 401k. Remember, for the Roth IRA, you have to make below a certain amount to even contribute to it. Okay, so we've broken down the differences between the IRA and the 401k, and we've also looked at the difference between the Roth incentive and the traditional incentive. So, which is better, Roth or traditional? So what should you choose between an IRA and a 401k? Well, you don't really have to choose because you can actually contribute to both, as long as you meet the requirements that we talked about in this video. So if you have an employer match, I would definitely say prioritize the 401k. But if you've maxed out your 401k and you're looking for somewhere else to invest, you can do both. And once the money's in there, it has the same tax incentive. So it doesn't really matter unless you just really don't like your employer's 401k and you would rather invest in your IRA. But now let's discuss what is better between the Roth and traditional incentive. Now that's going to be totally dependent on your situation, how much you make, and what your current tax liabilities are. So if you have any questions about this, make sure you meet with a tax professional who will be able to steer you in the right direction. But for the sake of this video and for fun, let's run some numbers to see what the actual difference is in the numbers between the Roth and the traditional incentive. So let's say from age 25 to age 65, you make $100,000 per year, and you invest 15% of your income towards retirement. For tax assumptions, we are going to use current tax brackets, but keep in mind that these are always changing. So when you're running your calculations, make sure you get the updated tax numbers for yourself. And I'm also going to assume you're single because that's going to affect the taxes that we pay. But either way, this should be a good gauge for showing you what the difference is between the two. But always remember to run the numbers for yourself and get an idea of what the situation is going to be for you. And lastly, because each state handles income tax very differently, we're only going to look at federal income tax for the purposes of this example. And for investment growth, let's assume an average rate of return of 8% a year. Okay, let's start with the traditional tax incentive. Let's say you go the traditional route and you invest 15% of your income into your 401k plan. That means that you're contributing $15,000 towards your retirement every year. And you're not paying taxes on that money you put in up front, which is great. Well, at age 65, you will have a little over $4 million invested, which is awesome. If you assume a withdrawal rate of 4% annually, that will mean you will have a pre-tax annual income of a little over $161,000 per year. But remember, because this is a traditional IRA, you have not paid taxes on that money yet. So you have to pay taxes on it up front. So you have to pay taxes on that $161,000 at this time. And looking at today's tax brackets, that would mean that you would have to pay roughly $40,000 in taxes, leaving you with $120,000 in annual retirement income, which isn't bad. Now let's look at the difference if you did a Roth. Now, if you decided to use a Roth 401k or a Roth IRA, and you also invested 15% of your retirement income, you took out $15,000 from your income, but remember, you have to pay taxes on that money right now. So at your current tax bracket, you would actually only be contributing $11,400 to your retirement after paying those taxes. In this scenario, at age 65, you will have a little over $3 million invested. But before you automatically assume that the traditional is better, let's break that down. Because assuming you also take a 4% withdrawal rate here, that would leave you with an annual retirement income of $123,000 per year. But remember, because this is Roth, you pay no taxes on that. So you get to keep all that money for your income. So you can see that this is actually a few $1,000s higher than the traditional account. And that difference will be more extreme in certain scenarios, or if you're a higher earner, the traditional might be better for you. So you just have to run the numbers in your situation to see what option brings you out on top. Again, higher earners are usually better off deferring their tax liability by using a traditional investment account, but that doesn't mean that's the best option for everyone. Most earners in America would be better off with a Roth. So again, crunch the numbers. If you need to, meet with a financial advisor or a tax professional to help you get this sorted out. The last thing I want to tell you is do not fall into the trap of the paralysis of the analysis. I get it. Investing for retirement can be extremely overwhelming, and you should do your research to find the best option for you. But both of the scenarios we just went through would have left you in a very good financial situation, and they were almost exactly the same. It was only the difference of a few $1,000s a year, regardless if they chose the Roth option or the traditional option. The worst thing that you can do when deciding between a Roth account and a traditional account is get overwhelmed and then not invest at all, because then you're going to miss out on all the wonders of compound interest. So yes, do your research, try to find the optimal solution, but don't let that analysis scare you away from actually doing it. And that's going to do it for this video. Let me know down in the comments if you like this video. Let me know if you prefer the Roth or the traditional investing option. Curious about your thoughts. Let me know. Make sure you hit that subscribe button. Make sure you hit that like button, and we'll see you in the next one. Thanks.